Let's jump right into this explainer and solve a classic valuation mystery that honestly trips up retail investors every single day. Picture this. You're looking at two entirely different companies. Stock A is sitting there with a $10 price tag, and stock B is priced at $100 a share. It's incredibly tempting, practically a hardwired psychological bias, to look at those raw numbers and just assume the $10 stock is the cheaper bargain. I mean, 10 is obviously less than 100, right? But today, we're going to see exactly why relying on that surface-level share price can lead you completely astray in the stock market. Because the truth is, a company's price tag tells you absolutely nothing about its actual value.
So how do we figure out if a stock is actually a bargain or if it's secretly way too expensive? Well, we have to completely ignore that surface-level price tag and look under the hood. And to do that, we need to answer one fundamental question. What is the PE ratio? The PE, or price-to-earnings ratio, is literally one of the most common ways investors measure whether a stock might be expensive or cheap. It is your absolute foundational tool for valuation. Once you master exactly how it works and, just as importantly, when it completely falls apart, it's going to fundamentally change how you analyze an investment opportunity.
Okay, let's dive straight into the core formula to understand exactly how this acts like a valuation scanner. The math here is beautifully straightforward. You just take the company's current stock price and you divide it by its earnings per share, or EPS. Now, you might be wondering, why per share? Well, standardizing the profit is really the only way we can compare companies of totally wildly different sizes. You see, when you buy a stock, you aren't just buying some ticker symbol on a screen, you are buying a fractional ownership stake in a real business, which entitles you to a fraction of its profits. So by dividing that share price by the earnings per share, you're calculating the literal price tag the market is demanding for just one single dollar of that company's profit.
But what does that final number actually mean for you, sitting at home looking at your portfolio?
Well, by doing this simple division, the PE ratio hands you a highly practical metric. Think of it as your payback period. Conceptually, it goes like this. Let's say you're looking at a company trading at $150 a share, and it brings in $10 in earnings per share every single year. 150 divided by 10 gives you a PE ratio of 15. What that effectively means, assuming the company's profits stayed totally flat with zero growth, is that it would take exactly 15 years for your investment to pay for itself through those earnings. Reframing the PE ratio as a tangible time frame in years instantly grounds a floating, abstract stock price right back into harsh reality.
Here's the catch, though. A PE number all by itself is totally useless in a vacuum. If someone tells you, hey, this stock has a PE of 20, that honestly tells you almost nothing. To figure out if 20 is expensive or cheap, you have to benchmark it. First, you can look at the company's own historical PE average over, say, the last 5 years to see if it's currently trading at a premium or a discount compared to its own baseline. Next, compare it against industry competitors. A high-growth software company might naturally sit at a PE of 40, while a slow, steady utility company might average at 12. Comparing that tech stock to the utility stock, that's totally apples to oranges. And finally, you can compare a stock against broad market averages, like the S&P 500, just to gauge how the overall economy is pricing risk and reward. Context here is absolutely everything.
As we dig a little deeper into our toolkit, especially when we're evaluating high-flying U.S. tech and growth stocks, we've got to make a really crucial distinction between trailing PE and forward PE. Trailing PE relies on past, finalized earnings data. It's basically like looking in the rearview mirror. It's incredibly accurate, sure, but it only tells you where the company has been. Forward PE, on the other hand, tries to forecast the road ahead by dividing the current stock price by estimated future earnings over the next 12 months. For fast-growing companies, looking forward is usually way more relevant, right? Because investors buy a stock for what it's going to do tomorrow, not what it did yesterday. But there is a massive catch. Forward PE acts a bit like a crystal ball, relying heavily on Wall Street analyst estimates. And, as any seasoned investor knows, those estimates can be overly optimistic or just flat out wrong. So sometimes, that crystal ball can get pretty cloudy.
Now let's move into our next section, blind spots, and exactly when the PE scanner fails. Every good investor knows the limitations of their tools, so we really need to look at where relying on just this one number can actually lead you straight into a trap.
And this brings us to one of the most dangerous traps out there, cyclical stocks. For your traditional, steady companies, the standard logic holds up perfectly. A low PE might mean it's a bargain, and a high PE means it's overvalued. Simple. But for cyclical companies, the ones tied heavily to economic booms and busts, like airlines, home builders, or auto manufacturers, that logic completely flips on its head. A deceptively low PE for a cyclical stock is often a huge trap. See, during an economic boom, their profits soar, making the earnings part of the equation artificially massive. That temporarily drives the PE ratio way down, right before the boom ends and earnings fall off a cliff. On the flip side, a sky-high PE might actually mean they're at the very bottom of the economic cycle. Their current profits are wiped out, shrinking the denominator, but a recovery buy is actually right around the corner. Buying cyclicals when the PE looks cheap is often exactly the wrong move.
Here's another major blind spot: companies that are just outright losing money. Seriously, picture your calculators smoking and breaking into pieces if you try to analyze early-stage biotech startups or massive tech companies that are dumping all their cash right back into growth. Because the math literally requires dividing the stock price by earnings. Having zero or negative earnings causes a flat-out calculator error. I mean, you can't mathematically or even logically calculate a payback period on a business that hasn't generated a profit yet. When you run into this, you just have to pivot to entirely different metrics, like the price-to-sales ratio, swapping out earnings for raw revenue just to get a gauge on top-line growth.
So the crucial takeaway here is that you don't build a house with just a hammer, right? The PE ratio is your foundational tool, absolutely. But to really master market valuation, you have to layer it. Step 1, you check the trailing PE to get a hard historical baseline. Step 2, you consider the forward PE to assess that anticipated growth. But step 3 is where the magic happens. You add in metrics like the PEG ratio. PEG stands for price earnings to growth. It takes that standard PE and divides it by the company's expected earnings growth rate. This is huge because it brilliantly adds context. Suddenly, a stock with a high PE that looks super expensive might actually be totally reasonably priced if its growth rate is just absolutely explosive. Layering these factors together, along with things like a solid dividend yield, is what gives you the true complete picture.
So, as you take this new toolkit back to your own investments, I want you to look closely at your portfolio and ask yourself, does your portfolio's PE tell the whole story? Have you been relying on just one isolated metric? Have you maybe unknowingly bought cyclical stocks right at their peak just because the PE looked like a bargain? True valuation isn't about whether a share price is $10 or $100. It's about deeply understanding the exact earnings engine you're buying into and exactly how long it'll take for that engine to pay you back. So keep digging. Keep challenging those surface-level numbers, and use these tools to uncover the real value hiding in the market.